information contained in this video and/or audio is provided as is for educational and informational purposes only and should not serve as the basis for any trading or investing decisions. Little Grapevine makes no representations and disclaims all express, implied, and statutory warranties of any kind to any viewer or other third party. Neither Little Grapevine nor any of its affiliates makes any endorsement of any particular company, security, product, or financial strategy, and nothing contained in this video and/or audio should be construed as investment advice. Please be aware that we and participants viewing presentations and/or live webcasts and engaging in Q&As may own, buy, or sell shares of featured companies. Investors should undertake their own due diligence and carefully evaluate companies before investing. Please see safe harbor statements of companies participating in Little Grapevine events by viewing their videos and slide presentations at littlegrapevine.com.
I would like to thank Little Grapevine for the opportunity to present to their investor network, and we have a number of questions that we'll be addressing. In the beginning, I'll give you a little background. My name is John McKimm. I'm the President, CEO, and founder of Smart Employee Benefits. We trade on the Toronto Stock Venture Exchange under the symbol SEB. I've been active in building and restructuring companies since the 1990s. My focus has been largely technology for the past 20 years. Previously, I had extensive experience in the capital markets and finance a number of technology companies and got involved in a number of operational restructurings as well. My educational profile is largely business and law. I'd also like to introduce Mohammed Al-Shaya. Mohammed is the Chief Operating Officer of SEB and my partner. He joined the company about 5 years ago and been very active in driving all the operations of the business. SEB was founded in 2011. We have over 600 employees and contractors in 11 locations globally, across Canada, India, and the Middle East. We provide leading IT and benefits administration software solutions and services, which automates and manages mission-critical business processes for our clients. Our sales in 2021 are targeted in the 70 million range, up from about 61 million in 2020. We expect continued growth in 2022 and beyond. We have visibility in over 80% of our 2021 revenue for the next 4 years. Our contract value is over 400 million. It drives recurring revenue. We have contracts out as long as 9 years. We have won over 69 million of new business in the past 6 months. We have now had 4 quarters of positive EBITDA and adjusted EBITDA. Our Q2 ended in May the 31st. That will be our 5th quarter and likely our best quarter to date. Over 90% of our business is recession resistant, tied to insurance, government, healthcare and benefits, and e-commerce. This market space has proven to be somewhat recession-proof. We are actively building over 150 blue chip and government clients, over 40 of which we've had for more than 10 years. We have another 40 plus we've had over 5 years, and in the last 1 to 5 years, we've added over 100 new wins to that client base. To sum up, we have a very high recurring revenue. Over 80% of our revenue is recurring over the next 4 years. In that over 400 million of contracts. We have a highly scalable operations infrastructure. Today, over 80% of every new gross margin dollar goes to EBITDA and cash flow. We have a positive EBITDA and growing. All business units are now cash flow positive and growing. We fully integrated 12 acquisitions since inception. We've taken out over 5 million of permanent cost structure, completely integrated the operating infrastructure, the leadership team, and the cultures. We have established clients. We have proven technology ecosystems. We manage mission-critical business processes for over 150 blue chip and government clients. We have multiple referenceable clients and contracts that meet the mandatories for most new client bids. We have a multilingual executive and operations management team with virtually 0 turnover in the last 5 years and decades of relevant experience servicing highly sophisticated clients. Our channel partner white label TPA business model is very unique in the marketplace, particularly for targeting the emerging marketplace, which is a new growth area for us. We are also introducing this year an acquisition investment in channel partners, which will expedite our high margin benefit processing revenue. Management believes we're undervalued, well positioned for growth in 2021 and beyond, both in business growth and in our valuation. So with that summary, we can move to our questions.
The company has roughly a 10-year history. Please discuss some of the key milestones you achieved and or failed to achieve, and talk about some of the company's darkest days.
Well, we've had good growth in our revenue over the years. Through acquisition, we created a strong recurring revenue client base and a proven suite of software services and solutions. The sales cycle for major clients has been longer than originally expected. However, once we win the clients, our retention rate has been well over 95% in the last 4 years. Some of our darker moments have really been around our reception in the capital markets. We invested heavily in software and benefits processing revenue, solutions, and client base. We've made steady progress in that area, but it's been very expensive. It has penalized our EBITDA, and up until 2019 when we started to be positive. Until recently, it's been challenging to access the longer term capital that we require to support growth. At the end of November, we raised 20 million from a strategic investor, a large Canadian insurance company, which is also a significant client. This has helped reduce our balance sheet risk and capitalize our business for a strong growth trajectory going forward.
Please discuss some aspects of your business that make it unique.
We have a very high retention rate with our customers. Today, over half our business comes from clients that we've had for more than 10 years, over 30% for more than 5 years, and in the last 5 years, we've won 100 new clients, as we mentioned before. The majority of these contracts are recurring revenue streams. We manage mission-critical business processes on long-term contracts. Our solutions are unique. You can't find them anywhere else. They're a combination of our own proprietary software and software of other companies that we've integrated into our platform, from regional and global, highly regarded businesses. It's a very cost-effective infrastructure. We respond very quickly to our client requirements, and this allowed us to deal with the majority of client pain points faster than our competitors.
Can you please provide us with some examples of some of the problems you're solving for your clients?
In the benefit processing side of our business, many of the technology solutions are older, a lot of manual processes. There's been high error rates, higher fraud rates, and poor analytics. Our solutions, those are the three major things. We have very cost-effective solutions. We automate more business processes than others, and we provide better analytics to make decisions on how they're spending our money.
Please describe the company's corporate structure.
SEB has several legal entities that we've acquired through acquisitions. We've made 12 acquisitions. We've amalgamated many of those acquisitions into business unit structures. The primary reason for maintaining the legal entities has to do with the nature of the client contracts. Many contracts have security clearances and vendor approval status, which is hard to transfer between companies. However, operationally, we have fully integrated the following. Our executive management and leadership is fully integrated across all of our corporate entities. Our finance and accounting is a common service. Technology delivery and support is a common shared services. Our RFP response teams are common. Our sales and marketing teams are common. So our budgeting processes are driven by legal entities and roll up into 2 divisional categories: benefit processing and IT solutions and services. Both categories have that we noted above have virtually 100% common operating infrastructures. The primary difference in benefit processing, it is a software and solutions driven business model, with a higher fixed cost structure, but also much higher profit margins. Our IT solutions and services is more a services-driven business model. It has a lower fixed cost base and driven by largely a contract labor force, but it also has lower gross margin. Both divisional structures have common clients and substantial interdivisional operations and synergies.
Please discuss how you engage with your customers and bid for contracts.
The majority of our business is won through RFP bid processes. We have a very strong multilingual RFP team that can respond both domestically and internationally. Once we win the business, we have separate infrastructure that supports and manages that client relationship. In the past 24 months, we have launched our channel partner business model. This targets the emerging market sector or companies with less than 500 employees. The majority of our clients today are government and corporate entities with thousands of employees. The channel partner model may require an RFP process, but typically it is a direct sales contract and negotiation with the channel partner who already has the direct client relationships. Where the enterprise and the public sector is a direct B2B sales strategy, the emerging sector is a B2B to B2C sales strategy. We deploy the same technology infrastructure and solutions in both market sectors, but with the channel partner model is a white label under the channel partner's brand. Our direct client is the channel partner, but our support organization works with the channel partner to interface directly with the channel partner clients, be that the corporate entity or the employees of that corporate entity. All of our contracts are long-term managed services contracts in recurring revenue in both segments.
Please break down your products and services for us.
We break our products and services down into two groups, really software-driven and services-driven. So under our software-driven, we have multiple SaaS solutions, we have multiple managed services solutions, different software products and stuff that are all provided to our clients. Under our services, that's all the services that are required to support that software-driven environment. Typically, each contract has a combination. If it's a software-driven, then the higher revenue streams, the higher margin revenue streams will come from the software, which is what benefit processing is. But we can't deliver those software solutions without also having the services side. But some contracts are more services-driven, which means it has a larger people component, but highly specialized skill sets. And all of the contracts are recurring and long-term managed services contracts that are looking to really manage mission-critical business processes for our clients. Mohammed, do you want to add anything to that?
Yeah, maybe I can add few pointers here. So as we look into the value chain of the products and services that we offer, we have different pricing schemes that generates revenue, multiple sources of revenue across the core technology, core software, core services, and it's all driven by annuity recurring type of engagement. So if we speak about the software, there is a subscription-based model. If we speak about the services, there is a time and material, and there is a fixed price project. And if we speak about the upselling and cross-selling of insured products and services, there is a premium and a percentage of premium that we generate in the form of revenue. Collectively, they generate what's so-called our optimized or our aggregated revenue within each of the divisions.
How much of your revenue is recurring?
Our revenue is virtually all recurring pursuant to long-term contracts, but it falls in three buckets. We have our per person, per plan member, per month revenue pursuant to long-term contracts. We have annuity commission streams of insurance solutions that we sell to our clients. And then we have a time and materials license fee bucket, also pursuant to the same managed services contracts. Each client may generate revenue from one or all three of the above buckets. Our revenue fluctuates between all three buckets with one commonality. It is recurring per long-term contracts.
Talk about some of the ways you engage with your customers.
Okay, today, our customer profile is largely government and enterprise clients, which basically means over 500 employees. The business from these clients is largely won through RFP processes and delivered pursuant to long-term managed services contracts once we win the RFP. We have a new growth strategy that targets the emerging clients, which is the under 500 employee. It may have RFP requirements as well, but typically it's a direct sales effort with the channel partner. So we deploy our technology in the infrastructure under the brand of the channel partner and support the channel partner's clients, which are both the corporate entities and their employees. The only clients that once a client is on our platform, being an enterprise client, a public service client, or an emerging client, it's hard for the client to leave. Typically, large organizations have recurring, have procurement processes which require them to go to market from time to time. And so we do have to bid there. But our technology is very strong. Our value proposition is very strong. Many of our solutions have automated environments that you just can't find elsewhere, or that is fully integrated and providing the better analytics that we have.
What are some of the reasons that you would or would not be awarded a contract you are bidding for?
With the government, you have to break that down into the three segments. Okay, the enterprise clients, the corporate clients, and then the government clients. The government clients is largely a solutions model, services model. We deliver those clients or services to those clients largely through contractors. Price is a very big factor with government clients, and along with the solution, because the RFP processes are very complicated. So any government clients that we've lost, pursuant to our RFP processes, we've lost usually because of price, somewhere along the price. Our solutions are often the leading solutions, but price is a big factor in that RFP process. If you look at our benefit processing, price is less a factor. It's really the functionality and the value proposition that we bring to our clients. And we have, with our proprietary solutions and the solutions that we've integrated from other technology entities, we have a very comprehensive program that can manage over 90% of all the business processes, automate over 90% of those processes with our clients. So our value proposition in terms of automation is very high and very cost effective. And we have very high levels of managed services agreements with benchmarks. So our clients really can't find everything that we have with any other one supplier.
What is your win rate percentage on contracts you are bidding on?
If you go back to 2017-18, we were around 30%. In late 19 and 20, we moved up over 50%. And in the last 5 or 6 months, we've had a win rate that's been over 70%. Whether we can sustain that, it's hard to say. But at the moment, we've had some very good success, and we think we can be pretty confident that we'll be between 50 and 70% going forward.
Why has your win rates on contracts you're bidding on recently improved?
Two things. We think that we have a lot more mandatory, we have a lot more contracts, a lot more references. Our solutions are much stronger. and more cost effective with the integrations and stuff we've done in the last 3 years and the cost structure we've taken out. And our technology roadmap is really driven by our clients. So if you look at how we've evolved our solutions, we've identified client needs, and we have created solutions to automate those and address those client needs. So more and more of the RFPs, we have an increased functionality with those as we respond to the RFPs. And we meet the more mandatories, and we have more client references. So that's been very helpful. Mohammed, do you want to answer? Do you have some add to that?
Yeah, thanks, John. We're very relevant to the client's agenda. We understand their demands, their requirements. We help a lot in transforming a lot of those requirements into business solutions and deliver value. Where we win over most of the time is when the client is looking for a strategic long-term partner who understands technology, but also understands benefits. So we can alleviate that requirements to help them operate and transform their benefits plan into a much integrated offering under our platform. Where we also differentiate is when we provide this product roadmap with a rich feature set of capabilities, functionality that is not only meeting the requirements of today, but also meeting the requirements of the future. And we have that capability. We have a very strong product roadmap, and we often present it to our existing clients and new clients. And this helps us a lot in our RFP response.
What does a normal contract look like across the divisions of your company?
The contracts are the same in both, in many ways. They're typical managed services contracts with defined deliverables and performance requirements. If it's a software contract, it satisfies and meets the mandatories of that the client requires to automate its business processes. If it's more of a services contract, then it has more emphasis on the skill sets and so forth that are required to manage those processes. But as I say, most contracts are a combination of software and services, and they all manage or automate to a high degree the business processes of our clients, and most of those business processes are mission critical processes.
Who are the key shareholders and insiders, and what are their backgrounds?
Well, I'm the largest shareholder and the founder of the company. The second largest shareholder is, or not shareholder yet, but the investment that we've got from the Cooperators Group, a large Canadian insurance company, in November the 30th, 2020, if they convert their $20 million, they will control about 30% of the company. That conversion is unlikely to take place for the next 2 years. That's a 5-year convertible, so it's long-term financing. And they're a very strategic investor for us, both in terms of new business opportunities and in terms of our infrastructure supporting their business initiatives. Executive management and the board own approximately 40% of the equity. We estimate that our employees own 7 or 8% because pretty much most of our key employees, and I would say probably 70–80% of our employees are shareholders in the company, either through purchase in the marketplace, participation in financings, or through RSUs or options. Closely held stakeholders that are close to me have about 30%, 35% of the company. So overall, about 85% of the company is fairly closely held, and by people that are experienced in the industry, have been partners for 4 or 5 years in the equity of the company.
When you first decided to join this company, what opportunity did you see in the business?
Well, when I founded the company, the focus was on the employee benefit side or the group benefit side. And my only experience up to that point was with other companies that I've had, is that every year I would get my group benefit costs and it would go up, and nobody could really tell me why. So it would be a moment of frustration for an hour each year, and then I'd have to bite the bullet and just move on with the business. So when I sold my other company, I came across, I had another business, and I came across a group benefits platform, a back office platform. So I did a fair bit of research in the industry, and I realized that both Canada, US, and globally, the technology in this space was pretty archaic, pretty old. A lot of high error rates, high fraud rates, bad analytics. Clients were forced to sign new contracts each year because who's going to cut the benefits for their employees? It's a kiss of death in today's knowledge-based world. Your employees are your single largest expenditure, and your benefits are your second largest expenditure. So it's a sector that's grown 48% a year in North America for the last 10 to 15 years, but the employees haven't grown at that rate. And I said, what industry do I know that is recession-proof like that, and where there is an opportunity to introduce new technology, take out cost structure, and provide the plan sponsors with better technology that gives them better analytics and helps them spend their money better. So that's what attracted me to the industry. And so, but on that side, you also realized that a lot of the clients had other technology solutions that were not leading edges either. So they all had to be upgraded and enhanced if you're going to put in place new benefit processing back offices for those clients. So we built both an IT software solutions and services group that would support the automation in the benefit processing software and solutions. So together, we can go into any client, we can upgrade any existing infrastructure that we have to interface with, and we can support it on an ongoing basis. We can do the systems integration, we can migrate to the cloud, we can do the software development, the enhancement. So we've got probably the most comprehensive environment for managing and upgrading our client environments in the marketplace. And that's been a big value added in winning and retaining new clients.
You recently announced a couple of new contracts, which you expect will result in a significant amount of new revenue. How much revenue do you think these contracts will generate on a quarterly basis?
We had a very high win rate in the last 6 months. It's been over 70%. We've won over 69 million of new contracts. We currently have over 100 million of contracts that we've responded to, bids that we've responded to, where we expect decisions over the next 6 or 8 months. And each month, new RFPs and new contract opportunities come to light. So we're continually responding to those contracts. So today we have over 400 million of contracts out over 9 years. That contributes to a large recurring base. It's hard for us to estimate how much we can win in any given quarter or any given month or so forth. However, RFPs continue with, in the early part of COVID, the RFP process has slowed down, but now that's building up again. And we see a continued, our biggest challenge right now is deciding which RFPs to respond to and which ones we have the highest probability for. So there's no lack of growth opportunities. There's just we have to make, every RFP is expensive to respond to, and we have to make decisions on where our highest probabilities are. So going forward, I think we'll continue to have high win rates. If you look in the last 2 years, we have more than replaced our annual revenue. And in this year, with the target of 70 million, we've already won in the first 6 months, almost 70 million of new contracts.
What is your strategy for acquiring new customers?
As we said before, the majority of our revenue is derived from RFP processes at this point. So we have a very strong multilingual RFP team. We spend a lot of money on that team. It's capable of responding both to IT solutions and services, as well as benefit processing solutions, software solutions and services. It can respond both domestically and internationally. And that's a big value added for us and a competitive advantage. And we have the mandatories and the client references, and we're getting more every day that allow us to respond to more and more clients. Now, a growth area, which is a bit of a change to the RFP, as we noted before, is the emerging marketplace. That is companies with under 500 employees. That's typically not a RFP process. It's typically a direct sales effort with a channel partner who already has the clients. So we have about 20 of those channel partner relationships that were in discussions. Each one seems to take a year to year and a half to come to fruition. We have a new strategy that we hope will expedite that growth, and that's an acquisition or investment strategy of minority interest. We believe if we can buy a minority interest in a channel partner, we can expedite the processing revenue from that channel partner, because our investment will fund the cost of standing up that white label environment. It won't penalize the channel partners' distributions, because most of these entities are private companies and where the owners take out most of the income annually. And the value proposition that we have for our channel partner is we can typically double their revenue by introducing new revenue models. We can reduce their cost structure and provide them much better client service. So we can make their existing client relationships a lot more sticky. So that's a high growth area going forward.
What do you think investors are missing or misunderstanding about your company?
Well, in December 2015 and through to April 17, and up to that point, we made a number of acquisitions. Our intent was to make acquisitions and with debt primarily, and then with the acquisition and hopefully our share price would increase and we would be able to refund those acquisitions in the marketplace. Now, that strategy did not work out as well. In December 15, we made, at that point, we had made some very good acquisitions, but we ended up with a lot of debt. So a combination of two things. That increased the risk profile of our balance sheet. And in Canada, in the Canadian capital markets, at that point, the whole capital markets was focused on the cannabis growth. So it kind of sucked all the oxygen out of the marketplace and didn't leave much money for smaller cap or emerging technology companies. So we were kind of trapped for a few years with a lot of debt. In addition, we had a lot of capital expenditures that we spent money on driving our benefit processing software and solutions and accessing or aggregating clients. So we suffered for the last 3 or 4 years with a highly levered balance sheet and not a very profitable company because we were expensing all of our CapEx, which was $6, $7, $8 million a year. And we spent over $40 million now in the last 4 or 5 years acquiring clients and acquiring and building technology. Now, in 2020, we came out of that. Our CapEx going forward is very minimal now. It's a few $100,000, and any evolution of our technology is typically paid for by our clients now with new add-ons and enhancements. We've taken over $5 million out of the permanent cost structure. We've decommissioned multiple technology platforms and consolidated them into one. We've had, through attrition, the automation of our business processes have increased our scalability. So we're in a pretty good position now to experience strong growth in our EBITDA and our cash flow. We've had 4 quarters of positive EBITDA now, and we'll have a 5th quarter for the end of May. And so I think going forward, we're well positioned to have our balance sheet with the $20 million we got from the insurance company last November, took a lot of the risk out of the balance sheet. And so we're a lot better positioned now for the investment community to start looking at us. And we're getting a lot better reception from both retail, and as of late, we've had a lot of calls from small cap institutional investors. And I think our stock price in the last month or two has reflected that. So we're looking more positively going forward.
What do you consider to be some of the most important future steps to ensure the growth of your company?
Well, we have three things that I think we focus on, and I'll make a couple comments and then I'll pass this one over to Mohammed. But we have a very strong technology roadmap. We have clients that give us insight into the marketplace on long-term contracts. They want to do things, and we're the ones that manage it and make it possible. So we have the insight of their thought leadership. We also have a very low turnover of our leadership and our key employees. We've had virtual zero turnover among the leadership in the last 4 or 5 years. We think that's pretty important because this allows continuity with our clients. It allows us to have long-term client relationships that match our long-term contracts. And the third factor that's important, very important to us, is the capital market support. We haven't had much capital market support from December 2015 until early 2020 or late 2020. But I think in 2021, we're starting to get that, and that access to capital markets with a better valuation in the marketplace. These are the three things that I think are quite important in ensuring or expediting the growth of our company. Mohammed, you have some comments?
Right. We're making few steps towards the sustainable growth of the company. Those steps are driven by organic growth initiatives, focusing on our existing client base, establishing stronger and tighter relationship with the consultants, the advisors, and the channel partners, but also unlocking new opportunities within the existing clients, introducing new products, new services, expanding the scope of the service to include other product solutions and services across our service portfolio. Then we have the new clients, where we're expanding our partnerships and relationships across the three market segments: the enterprise market, the public market, and the emerging market. And those partner network are giving us opportunity to engage and promote proactively a lot of our services and products and solutions to this marketplace. So that's an area we're focusing on. We're educating a lot of this partner network, giving them insights on our product roadmap, letting them know what we do, how we do it, how we deliver it, and then in return, they're helping us penetrate and increase our win probability in this market. Then the third step we're taking is in the inorganic growth. And those are really flagship strategic opportunities where we work with strategic partners to be able to deploy a full white label offering and introduce the traffic and more premium into our administration business. Those are larger scale, longer term, and we call them turn the needle type of opportunities and growth initiatives.
You recently announced the launch of your app marketplace. What is that marketplace? How does it work? And why is it going to be meaningful to the organization going forward?
The marketplace concept is not new in the e-commerce space, but in benefits and insurance products and other benefits related product, it's pretty niche. There are some core benefits that every employer provides to their members, And there are a lot of optional and voluntary benefits that an employer makes available for their members. And it's really by choice how much they want to consume, what is it that they need. And the way we're approaching our marketplace is slightly different. The way we're looking at it is for both larger market, public market, as well as the smaller market and the emerging market. With 5 generations now in the workforce, there are various demands and various needs for each of those generations. Millennials are different than baby boomers, different than Z generations, and their demand for access to benefits is different. So there is no one size fits all. And with our marketplace, we're going to make it available to all 5 generations with an umbrella of products that are relevant to each of those generations. And it will be available through a group benefit plan, or it could be available on a standalone and individual basis. The other thing that we have unique about our marketplace, we have the whole platform, the financial administration component of it, the regulatory component of it, centrally managed. But within the marketplace, we will be able to provision multiple digital stores. And it could be a wealth management digital store, a healthcare digital store, a insurance products like life, critical illness, other products, digital store, and so forth. So it's really a multi-tenant marketplace that has the ability to be customized based on the client needs. So super excited about this one. I think it's going to be disruptive, unique, and something that the market will resonate with.
What is your lead time to sign new customers when you're engaging with them? And are you thinking of ways to shorten that process?
We have, to answer that question, we need to look at our market segments. We have our public sector or government. We have our enterprise clients, which is more than 500 employees, and we have our emerging market. If you look at the majority of our business today, it's all RFP driven. Okay, and we have to win the RFP, and then we have to engage a managed services contract, and then we can grow the revenue from there. So we may win an RFP that's worth $500,000, but that will typically result in a multi-year contract. And as we work that contract and we identify other client needs, we can grow the revenue from the inside. So the contract can actually be much larger than the contract that we actually won. So that is, but RFP processes are driven by the client. We can only respond and wait for the decision. And typically an RFP process, if a client sends out an RFP process, we respond. It's a 6 to 12 month exercise. Okay. In the emerging marketplace, that's a more direct sale. That's a channel partner model, and that one is typically not RFP, but it still takes time. And the sales cycles are anywhere from, in an RFP and a channel partner relationship, from 6 to 18 months on from when you respond to when you get a decision and you're actually implementing and generating revenue. Because even when you win the RFP, if we win one today, it's quite likely it'll be 90 days or more down the road before we start generating revenue from that particular client. So there's always that lead time, and there's not much we can do about that. In terms of our channel partner relationship, the only way that we've seen to be able to expedite that growth is really through our minority acquisition investment program. So it's our belief that if we can become an equity partner in that channel partner, and as I said before, that channel partners that we're targeting here have the clients, typically private companies, smaller organizations, but have large client bases. If we can become an equity partner, we can use part of that capital to set up the white label environment so it doesn't dip into their pocketbook. And the value proposition is we can typically double their revenue. So that is about the only strategy that we have at the moment for expediting growth in the emerging marketplace. On the RFP, we're just kind of trapped in the cycle.
How are you approaching your merger and acquisition strategy moving forward? Would there be a business you would acquire right now if you had unlimited funds?
No, the acquisition strategy that we deployed up till now, we did about 14 acquisitions. We sold off a couple of them that turned out to be not as strategic as we thought. We don't really have opportunities that we've identified where we would go and buy 100% of any entity right now. That's not part of our go-forward strategy. Initially, that helped us consolidate client base. It helped us consolidate technology solutions and expertise, references, and so forth. Going forward, our acquisition strategy, as we noted a few moments ago, is really making a minority interest in channel partners, taking a minority interest in channel partners with the objective of expediting our benefits processing revenue. So that's our primary target market if you look out the next 24, 36 months for any acquisition or investment. Very unlikely that we would do any 100% acquisition going forward over the next 24 to 36 months. Our opportunity is really to grow that emerging market business and drive our processing revenue, which for us is very high margin business.
Where do you see the business in 2 years?
We think if we focus just on organic growth initiatives, we'll do 70 million this year. We see on our IT solutions and services, we should be able to generate 5 to 10% growth in that business just from additional wins and as the RFPs come out. So we're targeting growth sometimes in that range. We think on the benefit processing side, we have currently 330,000 plan members in our platform. We've signed contracts for another 180,000 plus we have RFPs out for additional. Our average revenue right now per plan member is about $45. That generates about 17 million of revenue this year. Each of those clients are spending probably over $250 per plan member with somebody. We're looking at capturing more and more of that revenue. So in the next 24 months with our existing client base, we're looking to take that $45 to somewhere close to $100, but our solutions will capture more than 90% of that $250. So we have the capability to capture a lot larger revenue. It's just a matter of how long it takes to do that with client decisions. But targeting, if you look at targeting the $100 over the next 24 months with our existing clients, that could take a $17 million revenue base to somewhere over 50 million. And that's without winning new clients. So that's the business strategy that we're putting in place, is how do we do that? And how do we capture more of that spend that the client is already driving? So I would like to think that we can enjoy some significant double-digit growth in the next 24 months in our benefit business, and most likely single-digit growth in our IT solutions and services. And the interesting or the more important thing to note is the growth in gross margin. Over 80% of every new gross margin dollar, whether it comes from benefits or comes from IT solutions, goes to our bottom line. If you looked from 2017 to 2020, our consolidated gross margins moved from about 17% to 33%. And in the first quarter of 2021, our consolidated gross margin was a little over 37%. So long term, I think we can move our consolidated gross margin to the 40 to 45%, long term being the next 2 to 3 years. And if we can do that, I think we can scale very quickly in terms of our EBITDA and our cash flow.
What kind of expansion opportunities do you see in your products and service offerings?
I'll give you a brief answer to this, and then I'll turn this one over to Mohammed. We have a pretty robust technology roadmap. That roadmap has been driven by our clients since 2017. And the value of that, and when I talk about the technology roadmap, I'm really talking about a lot of our SaaS solutions, our benefit processing solutions, and other SaaS solutions we have. So we have the benefit of having very sophisticated clients who are thought leaders in the industry. And when they come up with new things that they want to do, we're really the integrator, the developer, the manager, or the one that's managing those processes. So what they come up with, it's our job to automate it, to bring it to market, to manage it and support it. So that will drive a lot of our product service offerings. But with that, I'll turn it over to Mohammed.
Thanks, John. I think as it relates to opportunities, we're starting to move from extracting value into creating value in an underserved market like the emerging market. And by creating this value, we're able to consolidate a lot of a market that is fragmented. And I think we can expand that opportunity by taking away all of that expertise, experience that we've developed over many, many years in a very complex market like the large and the public market into a much smaller but sizable market segment will be extremely unique. We're very excited about it. We think, again, based on some targets and some consolidation that John was talking about earlier, I see us getting closer to a 10% market share in this 9 million employee market with benefits. So I see us in the next 24, 36 months getting closer to 1 million in the emerging market alone.
What level of revenue do you need to generate in order to achieve consistent profitability?
We are cash flow positive now. Keep in mind our profitability. We report under IFRS, not GAAP. The U.S. is primarily GAAP, but we report under IFRS. So if you look at, we did a lot of acquisitions. In those acquisitions, we ended up with a lot of goodwill or amortizable non-cash expenses. So by the end of this year, those expenses will be pretty much gone. So going into 2022, we should actually begin to report profitable, like actual profit numbers, that go beyond EBITDA. Even though we have positive cash flow and EBITDA is positive, the amortization sometimes makes the earnings look a little wonky. So most of that amortization will be gone in 2021. And moving into 2022, we should start reporting positive earnings.
Do you see gross margin improvement opportunities, and do you have a consolidated gross margin target?
If we, right now, the first quarter came in around 37%. We're not sure we can actually maintain that in the second quarter. We'll see where we're at there. But if you looked out 24, 36 months, we like to think there's a pretty good, with growth in the benefit processing, we like to think that we could get our consolidated gross margin into the low mid 40s. So 42, 45% would be our target. Longer term, we can continue to grow that consolidated gross margin because the gross margins on our benefit processing is depending on the particular solution is between 50 and 90%, where the gross margins on our IT service solutions are more like 17, 18, 19%. So additional revenue dollars on that side can scale that consolidated gross margin pretty quickly.
Does your business exhibit any significant operating leverage?
Well, operating leverage, let me define that as growth in EBITDA. Okay, so if right now we got 53 million of in 2020 or 2021 of IT services and solutions revenue, we should make about $5 million on that revenue, so roughly 10% bottom line, and that's on roughly an 18% gross margin. So if you look at the benefit processing of 17, we should make about 2 million this year on that revenue. But if we added 10 million of benefit processing revenue with a kind of an equal distribution across the various solutions, we could probably add another 5 or 6 million to that. So that's the scalability that we see in driving our EBITDA from additional sales on benefit processing. Very scalable on that side. And then from the combination of those two things, we need to deduct our corporate costs, which are typically in the 2 million, 2.2 million range, which would be audit costs, public company costs, director's fees, some legals and things like that.
Can you please discuss wallet, share, or cross-selling opportunities that exist within your company?
Yes, they all do. If you look at any given client, we not only do benefit processing, but we also do or have the opportunity to do substantial IT services, solutions and services business. So we do that with a number of clients. And give you an example. If you go back to 17, we have one client, for example, that we were doing 800 grand with that now we're doing 5.5 million with. There's a number of clients where we have doubled the revenue or added substantially to the revenue that we was doing with that client back in 2017-18. So we have Mohammed and his team in 2021 has introduced a whole host of cross-selling strategies and opportunities. So I'll turn this one back to Mohammed.
Right. We've been doing quite well with the cross-selling opportunity, and I think integrating our sales strategy and giving an incentive for cross-selling did give us a lot of attention and attraction. But also the clients are seeing a great value by engaging us and helping them in the various practice areas where we can offer our service. Like some of the clients, they are used and love the service they get through the benefits division. It becomes automatically a trust to engage the technology division to offer services like cloud, migration, infrastructure services, security, etc. So those conversations are continuously going on. We leverage a lot of our marketing campaigns. We leverage a lot of our account management meetings to continue to educate our clients of the various portfolio of services that we render. And we keep seeing more and more cross-sell opportunities coming to us from our existing clients.
How much revenue do you generate per person within an organization that engages you? And does that metric change within your channel partner business?
We have to break our business down into the two revenue streams, being the benefit processing, and that's the only revenue stream where revenue per person is relevant. On the IT solutions and services, that's typically not a per person. That's not that type. That's more a managed services. That's time and materials or built to service metrics pursuant to managed services agreements. And so we don't price it on a per person basis. But on the benefit processing side, which is the per person, we're doing about $45. A typical client would spend over 250. We're targeting increasing our 45 to 100, as I think I mentioned before, within the next 24 months or so. We currently have about 500, little over 500 clients under contract, of which about 330 are on the platform and 180 are in transition. So in our channel partner business, that's with our enterprise clients and government. With our channel partner business, those metrics are roughly the same. We think we may be able to expedite the revenue per plan member with channel partners a little quicker than we can with enterprise clients because the decision process is different. With enterprise clients, we work through the consultant and the plan design, and there's very sophisticated budget and decision processes. With emerging clients, typically smaller companies, that are controlled by the owners and so forth. So the decision processes are shorter. And so I think we can probably expedite that number with the emerging client base.
What are some of your next steps moving into quarter 3 and quarter 4?
Q2, we finished May the 21st or May the 31st. We finished Q2. It was a pretty good quarter. We'll announce that at the end of July, near the end of July, the last week of July. We should be at or ahead of our budget, so we're pretty positive on that. If you go out into Q3 and Q4, our biggest focus is hitting our budget numbers and exceeding them if we can, and then building a strong backlog or a stronger backlog for 2022 and beyond. So we're really streamlining. We're working on taking a few more costs out of our structure, although it's a pretty streamlined structure now. And we're working on developing more channel partner relationships, expanding on our existing channel partner relationships and educating them, and really setting the stage for stronger growth in 2022 and 2023 and beyond. We haven't created our budgets for 2022 yet, but we'll be doing that in the next 90 days or so. And right now, with our new business wins and so forth, it's looking very positive.
Can you talk about the strategies you use to reach your customers?
Our sales strategy, well, again, we need to break that down into two parts, right? The enterprise clients and public sector, government, and then emerging. And with the enterprise clients and government, that is an RFP process. So we do have to win the RFP, sign the contracts, and then the sales process begins. Okay, so under an RFP, you typically have to have the contract in place, and if it's a government contract, there's opportunities to capture parts of that dollar volume, because generally they have a budget around each of those contracts and a certain time period with opportunities to renew. And we really need to focus on how quickly can we bring that revenue or supply the resources and the skills and stuff that they need to expedite that revenue faster. So that's one way. So that becomes a sales, really a client management exercise. Now, in terms of the benefit processing side, if it's an RFP win, the same sort of thing. We have a client manager that works with that client to upsell or cross-sell or identify new opportunities where we can add value to that client. So once we're in the door, we have an opportunity to grow the revenue with that client, and that's a big growth focus going forward right now. We've done a pretty good job with a few clients from 2017 and on, but we see that as a significant organic growth area for us in the next 24 to 36 months. So that's about the only way that we can really, that's really our sales strategy. Win RFPs, and then once you get your foot in the door, help grow the revenue with that particular client around that RFP or around that contract. And with the emerging client base is structure the channel partner relationships and then work to grow the revenue with that channel partner with the end client.
You have recently raised convertible notes at 10% interest rate. What are you going to do with your money?
The $20 million, we had where our balance sheet was quite leveraged going into 2020 and 2021. This $20 million really consolidated short-term debt. Okay, dealt with some payables, but mostly it consolidated short-term debt, capped our interest rate at 10%, and we have the opportunity to reduce that interest rate down to 7% as we generate more business for that channel partner, more premium business. So we're working closely on that, so that should be able to reduce that. So that's where the 20 million went. We also raised a 10 million operating line, which we have. We're using about 4 or 5 million of that at the moment, and so we put that in place. So that's pretty much all of our debt, and that operating line has a 3-year term. So technically it follows out of current liabilities and moves into longer-term debt. So that's pretty much all of our debt at this point, and that really helps us strengthen our balance sheet and our working capital.
Do you believe the company will have to raise additional funds to execute its growth strategy?
We're generating positive cash flow now. Sales are growing, bottom line's growing. That helps us in a lot of ways. We expect to have substantial growth in 2022 over 2021, and that'll generate more free cash flow. So we can, the growth strategy we have, not the acquisition strategy, but the organic growth strategy, we can execute with our existing capital. We've had indications from strategic partners that were and channel partners that they would like to make an investment in our company. Whether we take it or not, we don't know. We'll see how the discussions unfold. But with some of them, we may take equity money from them if the business case is strong enough. So if that particular partner needs to have an equity position in the company of 5 or 10% to allow us to capture substantial new revenue from being their future technology partner, we would look at that. If our share price escalates, we think, which we have some good reason to think we are positively disposed to that. If it grows and gets back into the 50-cent range equivalent, we may raise maybe 5 or 10 million of equity. Not that we need it, but it would allow a few institutional investors to come into the marketplace who don't really like to buy a lot in the marketplace initially. They like to be positioned, and we have interest from there. It would also give us a little more flexibility in our working capital as well. So we're not looking to raise equity right now, but there are scenarios where we may take 5 to 10 million of new equity, either through a strategic partner where the new business far exceeds any effect of the dilution, or where we attract certain investors that can be very positive going forward.
How much debt do you see your company carrying over the long term?
Let's say our 24 to 36 month game plan is our only debt will be our operating lines, which are really our variable operating facilities that are tied to our receivables. And so we'd like to get rid of all of our long-term debt, get in a stronger working capital position, and basically just use an operating line, as we may need or may not need. So we've had enough debt over the years. We want to get rid of it. And I think in the next 24 months, we can do that. 24 to 36 months, we'll have no debt except for our operating lines.
Do you have any plans of executing a reverse split or share consolidation?
We looked at our market. We've got 172 million shares outstanding, and we've got dilution from the convertible for about another 80. And so when we looked at it, we said at this stage, doing a consolidation would be likely a good thing. We've had a lot of calls from small cap funds and analysts and various constituents in the investment community, that have indicated that, if you had a higher stock price, maybe a fewer number of shares, we think you would be perceived as a stronger institutional quality investment. And analysts were telling us that. So we got approved a consolidation of 1 for 5, which would take our issued and outstanding down to about 34.5 million shares. So our intent is to execute that on that in the next couple months. We're putting in place now all the additional approvals that we need, which is the regulatory filings and so forth, with the expectation that we may do that in May, or not May, in July. And we think that'll be positive. I mean, the feedback we've had will be positive. It'll take our stock price at the current price of 30, 33, 34 cents. It'll take our share price to $1.50 plus. We think that'll be perceived positively, or at least that's the indications we're getting back from analysts and from capital markets types and small cap funds. So we're targeting looking at that in doing that in July.